This is like one of the big anxieties of, banking regulators and central banks. They view stablecoins as a threat to credit creation.
I know you've argued that it's systematically underpriced in DeFi. Why do you think the market still kind of misunderstands risk after all of these cycles?
DeFi works best when it does the least. All of the hacks tended to happen with systems that were very complicated.
Do you ultimately see stablecoins being used as the de facto payment then, long term, even outside of crypto?
Credit cards are okay, but stablecoins are just better. They're quicker, they're cheaper, and they're more transparent. I look back to this analogy of the Pompidou Center in Paris. You put everything on the outside, you make everything transparent. You show how the plumbing works to the users that come to it.
Today's guest is Adrian Castanero Vasilla-Reach, co-founder of Steakhouse Financial. Steakhouse is one of the biggest companies in DeFi asset management and vaults, managing more than $4.5 billion in on-chain assets. It powers earned products for companies like Coinbase, MetaMask, and Robinhood. And through its spinoff business Grove, it's bringing RWAs on-chain at a big scale. There's a lot to discuss today. So Adrian, welcome on.
Hey, thanks for having me. Yeah, happy to chat.
Thanks for being here. Before Steakhouse, I know you spent time at Goldman Sachs and Bain. What was that experience kind of like that made you, one, maybe want to leave and co-found this business alongside your other founders?
I did M&A at Goldman. It was a very short period. I enjoyed it a lot. It was definitely one of the highlights of my corporate career. The people there are super driven, super helpful, super interesting. The work is amazing. I found myself actually admiring more often the clients than bank, really. So, the bank was in the business of advising these incredible businesses, and it just left me feeling like, okay, maybe that's more like something I should be doing rather than actually just being on the advisory side. And that kind of led me to entrepreneurship through a longer route. Like we don't have to go into it if you don't want to. I ran a small business in Switzerland and eventually started sort of contributing, part-time moonlighting in the evenings to the Maker forums, which is where I met my co-founders.
Mm-hmm. You're right. They're from like Maker/Sky, right?
Yes, exactly.
Your co-founders? Mm-hmm.
Yes. That's where we started. We were one of the core units of Maker, the strategic finance core unit, and later, first the real world finance core unit, then the strategic finance core unit, then the real world asset core unit. Now we're a star. Like this to give you a sense of the chaos of DAOs as an organization.
Mm-hmm.
But the three of us are very different. We're very distinct. But what brought us together was that we saw Maker as a better type of bank, really. One with a transparent balance sheet that could be reviewed in real time. We developed the financial statements for Maker based on like the double entry accounting ledger, which was a really cool exercise. It was the first instance I could think of where you could look at a bank and track and audit every single transaction all the way down to, the individual smart contract movement. For us, this was like a revelation of like, this is how you can actually make a better form of finance, with all of the risks on the outside. Because the three of us, we're from a generation of people that sort of came of age in 2008. So we really got like the brunt of, the global financial crisis. And so kind of growing up in the debris of that, you came away with, the chaos, the credit contraction, the financial instability, all of these things, I think colored our perception of how you could do finance better.
Do you feel like what you're creating is maybe an improvement or a solution to exactly that?
In some regards, look, DeFi is a chaos. That's part of what makes it so interesting. It is like a frenetic, chaotic, environment of innovation where people are like free to experiment, right. And, things blow up and things get big and so on. That's part of this effervescence, I think, is really crucial to developing really innovative, protocols and solutions. I think we're onto something. I also think DeFi is at a level of maturity, which is still very much, in the process of maturation. It's not,
mm-hmm.
it's not there yet. But I do think we're getting close. Like I was having this discussion about loss rates in DeFi on Twitter with a guy called Tom Dunleavy. And he was estimating across the whole of DeFi, the loss levels were something like 1 or 1.5% of the like total TVL, something like this, which like, okay, in principle, it's not a super useful heuristic because you wouldn't look at the loss level of like corporate loans.
Mm-hmm.
You would look at like a specific asset class, or you would like drill into the detail of like, oh no, high grade, low grade, investment grade, sector A, sector B. But just as a, rule of thumb, like 1.5% puts it on a sort of double B credit rating benchmark. And frankly, I feel that's probably right. Like that's probably where we are. 5 years ago, we were probably well below double C. Like now we're in like double B. So eventually we will get to a place where you can actually do investment grade stuff on chain. So yeah, I'm confident that we will get there.
What time frame do you think that would be? And do you think the time frame will be as long as like what it took for us to get to where we are today? Or is it going to accelerate at like a faster speed?
I think I'm hoping that it will have a tendency to accelerate. We're very sanguine about this. Like I don't want to overpromise. Like fintech is littered. It's a graveyard of
There's
people.
There's a lot of overpromising. Yeah.
There's a lot of overpromising. The reality is people's behavior takes a very, very long time to change. I think it will take a very long time before blockchain-based settlement is a meaningful part of the settlement of overall finance. But I also think that we can get to a place relatively quickly where I think we should feel confident that we can actually do these transactions at scale. Like you were mentioning Grove earlier. This is one of our projects. We're developing a protocol called Grove on behalf of Sky, the stablecoin. And on the one hand, it has this sort of allocation mission, which is to sort of allocate the assets of the stablecoin following the rules of the Atlas, the rules of Sky. But it also develops products that make DeFi a bit more usable and a bit more useful. And one of those products is Grove Basin, which is a settlement financing facility for tokenized money market funds. And I think this is quite sophisticated. Like this is quite good. This is, it's an example of how like we're trying to help bring the whole industry into a higher stage of maturation by developing products that institutional users can feel comfortable actually using.
Mm-hmm. Why separate Grove from Steakhouse opposed to keeping it within Steakhouse's like stack of products and services?
I mean, the simple answer is it's a protocol. It's not a Steakhouse product. Grove is a protocol owned by Sky. So we're developing it on behalf of Sky. So there is we are the development company for the Grove protocol. But the Grove protocol has its own governance, and that governance is mainly owned by Sky token holders. So it's not a full, let's say, Steakhouse product. But I also think that we're a good team to do it because we have, a track record of building with Maker and like a clear vision of the sort of things that we could do with access to the Sky balance sheet.
Right. Okay. And then if you had to explain Steakhouse to someone who spent, their career at somewhere like BlackRock or PIMCO, what would be kind of the easiest analogy for this? And how do you kind of explain what an on-chain asset manager does in comparison to the traditional asset managers?
I think asset manager is like a nice shorthand. I think it would probably, like in my experience, trying to use it, it confuses people more than it helps explain. People have the idea of like, they have the idea of like custody, this, that, the other. I think we're, Steakhouse is a company that's focused on building a credit layer for stablecoins. If you don't know what stablecoins are, we maybe have to explain what stablecoins are. But if you do have a sense of what stablecoins are, then I think it's generally like appreciated as something that's novel. People don't have the idea that you can actually do credit at scale with stablecoins. And we strongly believe that you can, and we're building our business around that presumption. And then if you want, you can also think about it as a unbundled bank. Like I look back to this analogy of the Pompidou Center in Paris, this, museum that has all of the pipes on the outside of the building. That's kind of how we view how you would build a credit layer with stablecoins. You put everything on the outside, you make everything transparent. You show how the plumbing works to the users that come to it. So yeah, unbundled bank, I guess, is another. It's like one small part of an unbundled bank. That's the sort of thing that you need to do if you use stablecoins as a means of payment.
Do you ultimately see stablecoins being used as the de facto payment then?
Yeah,
long
for sure.
term?
Yes.
Even
absolutely.
outside of crypto. Yeah.
Absolutely. Like this is we strongly believe this. To us, it's such a clearly superior way of using money, of issuing private liabilities. I do think it will take a very long time because these things do take a very, very long time. But we also think it's inevitable. It's also the sort of thing that is bound to emerge when you have, it's funny because payment systems today, like fiat payment systems, are very centralized and very dependent on specific jurisdictions. You have like Fedwire, you have SIPA in Europe, the BICAS and British system and so forth. And by default, none of them speak to each other. In fact, the Eurozone has spent a considerable amount of resources to ensure that, 19 or 70, or however many Eurozone countries there are now, that can speak to each other and just send euros, like just a basic thing. And SWIFT is sort of a duct tape solution to try and get these wires to speak to each other across the world and between these jurisdictions. But with blockchains, I think you have an opportunity to kind of do away with all of that legacy baggage it means that you can reset the compatibility and make everything speak the same language and have all of the different currencies work on the same layer. It also means that adoption is going to be very, very slow because you are just like throwing out everything that was before and you're saying, I don't know about any of that. We're just going to use this new system and that's what we're going to settle on. And, it'll obviously take a while. But we're very bullish on the idea that eventually people will use this, if anything, because from a secular trend perspective, consumers that are born into a digitally native world will expect digitally native means of payments to do stuff. And like credit cards are okay, but stablecoins are just better. They're quicker, they're cheaper, and they're more transparent. And we think that's a much better system to build large scale financial systems with.
Mm-hmm. Do you find that they are starting to get a hold of that now? Because I feel like from what I've heard from conversations with people who speak to, these big banks or traditional firms is that like they're starting to show interest in either integrating it, creating a system for it or something like that. But do you think that they're ultimately ready to do it, or there is still some apprehension, especially around maybe the controversy that we saw on the front of yield with market structure and things like that?
Yeah.
And Coinbase kind of pushing for the yield aspect in stablecoins too. And then all of a sudden, some of the banks maybe weren't necessarily happy with that behavior. That's a high level interpretation here, but I'm thinking about like, I see the value and I think some of them do too, but then it's like, do you find that they're apprehensive because of everything that's like transpired over, let's say, like the past 6 to 12 months?
Well, it's like there's a bit of an innovator's dilemma, right? In commercial banking. So, these are enormous businesses. Stablecoins are objectively a tiny fraction of it. Why rationally you have no reason to pay attention to this or spend any effort or investment on it, like realistically. And if you are, it's because you're trying to get ahead of the curve because you see the tide sort of changing. And that tide seems to be changing in ways that are very disruptive to your core business. And so there's this innovator's dilemma of like, yes, if we help boost, like one way that stablecoins could really take off is if all of the banks started using them and then like switched over a bunch of capital from fiat deposits to stablecoins. But doing that would significantly impair the commercial viability of deposit banks that depend on having deposits, right? So there's this dilemma of like, they view it in a strictly zero sum sense. One stablecoin equals one non-deposit on their balance sheet. I think you will see more adoption faster from the more fintech space in particular, and especially the crypto adjacent ones. So like Coinbase is a very good example of a company that's pure crypto exchange, full in the industry and moving towards things like, equity brokerage, traditional financial services, payment cards, that sort of thing. Robinhood kind of in between, a very much a traditional business, but one that's always been anchored on staying at the forefront of innovation and doing crazy things to disrupt the industry. So crypto is also like a natural next step for them. I feel like you'll get more competitive pressure from like these types of players before the banks really start paying attention. And then to your point on like the yield, like it's true that one for one, if a dollar leaves a bank, a commercial bank, that's one less dollar that can be multiplied into credit, let's say. And this is like one of the big anxieties of, banking regulators and central banks. They view stablecoins as a threat to credit creation. We're a bit more sanguine. And so this is why a lot of banks have been against the idea that stablecoins should pay yield. For them, it's a way of using regulation to block a potential competitor. The regulator will enshrine this rule in the language of, let's say, consumer protection, because it's generally bad for the consumer if conditions for credit deteriorate. But in practice, it's a sort of competitive blocking exercise, because one of the ways that stablecoins have to compete is the interest rate. And if you take that away from them, you significantly impair their ability to compete.
Mm-hmm.
But yeah, we're sort of one step beyond that. We take the world of stablecoins as it is without native yield, and we think about how do we use this new instrument, this new private money-like liability to issue credit, to create credit and conduct economic activity and increase the GDP of DeFi. which is an angle that banks haven't maybe picked up on yet. Sorry, I'm ranting a lot. I'm going in a lot of directions, but I get very excited.
No,
about
that's
this.
what you're here for.
Yeah.
You're the guest. You're allowed to say whatever you'd like here. It should be no surprise to our listeners that market maker quality plays a major role in any token's liquidity, trading conditions, and ultimately its price. But until now, market makers have been difficult to compare and impossible to judge based on performance. Forge is changing that with its market maker leaderboard, which is now live on DeFi Llama and Strata Media's Token Relations. Using data from 500 plus token projects, it grades leading market making firms from AAA to CCC. For traders, market maker quality is now an important metric to study alongside volume, TVL, fees, and unlocks whenever evaluating a new token. And for token projects, the leaderboard is the go-to resource for determining the best market makers to work with. For more details, go check it out via the link in the show notes. I know I brought up Coinbase in the intro. We were just talking about them a bit, and Coinbase, MetaMask, Robinhood, Safe, Crypto.com, all these companies have selected Steakhouse for their own products. How do you kind of think about building trust with firms like Coinbase and Robinhood? And then what is the due diligence process for that actually look like when you're up against maybe other options for them, right? What was that process really like? How long does it take? And what were they ultimately looking for that led to them picking Steakhouse? And imagine there's probably some differences for each one, but collectively, high level, these are the types of things.
So there are certainly some differences, but generally speaking, the processes more or less look the same. They look for the same things. And so when you're up against, when you're up against a traditional finance player that's moving into curation, you're faced with the same questions and expectations. And, not to go into detail about what that process looks like, it's very exhaustive. There's an element of sort of diligence and looking through the founders, their backgrounds, the company, how it's organized, the processes, the security, and so forth. Ultimately, and this is our view, our philosophy of how we are going to win in the curation space or in this mini industry is we're just going to focus on building products that fit the best to what we think institutions will eventually be asking for from these products, and make the least amount of bad decisions such that our track record speaks for itself. And we've reached a point now, I think, where, knock on wood, we don't take our users through any misfortunes, but I think, we've accumulated a collection of good decisions, mostly around saying no to things and being very strict in how we apply our risk management process and how we configure our vaults. And that reflects in TVL over time, trust and brand value, to the point where it can compete against a very, very large brand name from traditional finance and beat them on these proposals. And so we're, obviously very proud of that, but every proposal is a new fight, and we take it like we're doing it from scratch every time.
Does this apply also to non-crypto native companies and enterprise businesses, or is it different for them, given they're not very crypto native?
All the more, in my view, because crypto native businesses you will have a common understanding of certain jargon and terminology, and they will have maybe more opinionated views on what they want the product to look like. A company, in non-crypto native companies, they're more often in the process of discovering what the product fit is within their portfolio. The sales cycle is much longer because they still have to often work out what is it that we actually want, or what are we trying to achieve here? Crypto businesses are a good place to start because they already have stablecoins. And what these vaults do is they solve a problem for custodians of stablecoins. They give stablecoin users the ability to lend out those stablecoins without taking custody or intermediation or facing a discretionary black box or what have you. A business that has no stablecoins is not going to find it very useful to integrate this vault. And so it's part of a broader conversation of why are you looking at this? What are the things that you hope to gain? The cost efficiencies, the things like this. But ultimately, you also have to do an education process to sort of speak a plain language and bring people on the journey of why they should use stablecoins, how they should think about vaults, how they should think about credit origination and product creation and things like this.
Yeah. I think also on the front of risk, I know you've argued that it's systematically underpriced in DeFi. So why do you believe that, one, maybe? And then two, why do you think the market still kind of misunderstands risk after all of these cycles that we've been through? Is it because it's constantly evolving and changing, or something else?
Underpriced in the sense that I think it's riskier than people think it is, or the other way around? Or do I?
Underpriced in the sense?
Because I think I would say it depends. I think I would say actually it depends.
Okay.
I think I think that so in the world of over-collateralized lending in DeFi, like to simplify DeFi to lending, in over-collateralized lending against Bitcoin and ETH, my view is that it's more or less fairly, whatever that means. Like it's not surprising. Let's put it that way. I mean, fundamentally, my view is that if the market thinks that's what the risk is, then that's what the market thinks the risk is. I might disagree, but it's the market's view that prevails, whether the market is correct or not. For high yield is where I have, I was talking about this discussion with Tom Dunleavy. We were arguing very much around this sort of high yield lending, because you definitely saw a practice of curators, like smaller curators, trying to gain TVL very quickly by adding extremely risky collateral to get a very high lending rate and grow their vaults that way. And this is like a practice that we shunted. We did not do on purpose. This is the sort of thing that eventually blows up, right? That particular risk was certainly underpriced. Like adding very risky collateral, adding stream finance as collateral in a lending vault means whatever lending rate the lender is getting is way underpriced relative to the risk that they're taking, in our view. And that played out, right? But then for more standard high yield vaults, like the Coinbase high yield vault or whatever, pick a Steakhouse high yield vault, what we try to do is select collateral with a bit less liquidity, with a little bit more credit risk, but do it in a way where these risks are mitigated in the most. And that should give you a spread of a few percentage points over the prime. And that's kind of where they are. And that's kind of where they play. And what Tom was arguing was that this was extreme, because the first quarter of the year was very much a sort of wake-up call to the industry. Went wrong with all these hacks. And the thing with DeFi is that when something goes wrong, it goes really, really wrong. This is just the physics. It's just the physics of DeFi. It's just how it works, And having so many of them in one quarter relative to
it doesn't help.
Previous year,
yeah.
No, it doesn't help.
No.
So it's very difficult. Yes, it is risky. But I think the nuance that we try to bring to that discussion is like DeFi works best when it does the least. All of the hacks tended to happen with systems that were very complicated and had a lot of roles that had a lot of off-chain logic or components to it. And it was more often these off-chain components that were getting compromised, not necessarily the smart contract. And so if you took the approach of making things more minimal and simpler and dumber and hardening the governance surfaces, you can't eliminate that risk, but you can significantly mitigate it.
Yeah, I like that. DeFi does best when it does the least. Is that kind of the mantra for you guys then, to make it as simple as possible? So, there isn't any risk of, there is less of a chance perhaps for exploits and things like that, because it's much clearer than like a whole spaghetti of code in the background or something.
It's kind of one of the co-founders of Maker, Nikolai Mushegian, had like these principles of DeFi, and one of them was like, incentives are like a natural law. They're like gravity. So you need to organize DeFi systems so that the incentives are compatible. And the other was that if something can go wrong, it will. So if you allow a state to exist in your smart contract, somebody will figure out a way to put your system there. And so that's what we mean by dumber. So this is why we like the Morpho ecosystem, because the Morpho smart contracts are very dumb. They're very simple. This is kind of the philosophy that we share with Paul Frangot. Like the smart contract that does the borrow lend is like 600 or 700 lines of code or something. And then all it does is is a ledger of, who owes how much to whom and what do you do if you have to liquidate, something like that. And vaults, the vault Morpho vault construct is similarly very, very simple. It's just a share accounting spreadsheet, essentially. And it doesn't mean that you have to give up on complexity. It just means that like the very, very, very basic things, you pare them down to their smallest possible unit, and then you rebundle it and create complexity on top of that. But you do it with a system that's much more hard, that's much more hardened than if you try to do something complex from the outset.
Talk to you more about vaults. It's definitely something that we're interested in on our side of things. The Strata Media, with the coverage of all these different things going on, it feels like there's constantly just new vaults popping up. Obviously, there's some dominant players in the space, Steakhouse being one of them, I would argue. How would you describe the state of vaults today? And like, why are they so popular right now? Like, what has changed over the past couple of years that have like made it like the hot thing that everyone wants to do over the past like 6 to 12 months?
Yeah, it's true that it's very much sort of in vogue. We started on the vault journey in 2024. So we were speaking with the Morpho team and they asked us, do you have an idea of any teams that could do like a real world asset vault or something like that? And we were like, we've never done vaults, but yeah, exactly. We will do the vaults.
We'll try.
Okay.
Yeah.
Yeah. That's kind of how we started. And what I think is exciting about it is, okay, here's what I think is exciting about it. The barrier to entry is basically zero. So anybody can make their own vault if they want. It means that anybody can experiment. There's tons. If you look at the factory for the Morpho vaults, they're just printing out vaults constantly. And people are just using it as a platform. And, you can do that when you have a very simple open source contract that you can, look, twist, pull in every direction, do different things with, experiments and so on. So I think that's part of the reason why so many people have like leapt onto it, because you can very quickly project like, oh, I have an idea for this. I'm going to make a vault, right. And then you just print out a vault and it goes. I think it also speaks to the values of DeFi that are useful for traditional finance. So like when thinking about mitigating risk in finance, some of the things that DeFi products can offer is mitigation around speed, composability, and atomicity, but also mitigation around settlement risk and mitigation around counterparty risk, if done well. Like these are really the main reasons you would transact on DeFi in the beginning. Like if you don't have those things, it doesn't make any sense to do anything in DeFi. But because Morpho is so easy, like it makes it so easy to get those things, it's very easy for asset managers to project themselves and think like, actually, we've been working on tokenization for, years. Finally, we have a way to like, this is how it could look like in DeFi. Like, so why don't we experiment? So I think that's really why it's sort of captured the imagination. And as for the market structure, I definitely think Steakhouse is the biggest Morpho curator. We're not the biggest curator overall. Aave, I think, is the biggest curator. If you think of Aave as a monolithic curator, we're not far off from there. Hopefully we will get there one day. We do think that the industry is in a stage of like development where, since it's growing, like it's a pie expanding type of environment. So everybody can kind of find a place, right? At the moment, it's very concentrated because everybody's kind of doing the same thing. But as soon as we start to see more real world integrations of this technology in different financial products, we'll start to see the vault specialist for X, or just vaults used as spreadsheet software for something else and somewhere else, So we expect to see that sort of expansion rather than consolidation over time.
So it'll expand instead of consolidating around a handful of firms or vaults is kind of the thesis here.
I think so. Because really in DeFi today, it looks very consolidated because we are basically doing the same thing. And so, the total market size of DeFi has not expanded very much over the past few years. So yes, you do see the effect of some consolidation in the sense that you have Steakhouse and then you have like everybody else. And you have Aave, Steakhouse, and then everyone else, something like this. That's because we're all playing with the same users, the same funds, the same capital, and DeFi market size hasn't grown in like 2 years. I think it will change because I don't think DeFi is going to stay stuck here forever. I think it will go back to growth, and we will get new things that happen on chain that we haven't even like conceived of, that will use vaults in completely novel ways. So yeah.
If you're building with stablecoins, the question isn't can you just issue one, it's who do you trust to get it right. Regulated stablecoin issuance starts with Anchorage Digital. Home to America's first federally chartered digital asset bank, Anchorage Digital brings a level of regulatory standing most players in the space simply don't have. This means end-to-end stablecoin issuance built on a compliant foundation. Pair that with correspondent banking that connects stablecoins to the traditional financial system, and tokenization infrastructure that lets institutions bring real-world assets on-chain securely and within the rules. To find out more, visit anchorage.com.
What would you say is the TAM then for vaults on-chain credit in the current market? And then with that in mind, how do you think about actually underwriting, billions of dollars in on-chain credit if it gets bigger and bigger?
It definitely, it's downstream from stablecoins. So you need stablecoins to increase adoption for vaults to really take off as a way of building credit products. And so it will always be constrained by total stablecoins. That's kind of the TAM, I would say, the maximum TAM. For underwriting so one of the things that I think DeFi does best is scalability. Steakhouse is a very, very small team, and we haven't grown that much in 2 years. And I think it shows that you can, with a relatively small platform, scale to absolutely enormous degrees because you're basically replicating, automating, and using a platform to like scale more and more. I definitely think that we need to see more standardization in the asset side. So at the moment on tokenized assets, you see a lot of like traditional funds wrapped in a token in like 5 different jurisdictions in 3 different flavors. And you see that like replicated for each thing. I think having some more standardization would be helpful to get there quicker, because otherwise, that's one of the biggest roadblocks that we have at the moment. It takes forever to like underwrite and onboard an asset, and then you have to do everything all over again from scratch for the next one, and it's just annoying. Like eventually, I
How
think
long
that
does
the
it take
industry
currently?
could take months. Like it depends on the complexity of the asset. Like a private credit token, the Fasanara assets that we've underwritten, these are months of work of speaking to the portfolio managers, understanding the positions, looking at the loan tape, and understanding the token structure. Like this takes time. It's obviously this is the biggest bottleneck at the moment with onboarding real world assets. You can't do this for every single real world asset. It's impossible. So I think the industry will pressure all the issuers eventually to sort of conform to basic standards, so that we can move on, like not have to worry about the basic things and just focus on like the quality of the asset, the credit books, the quality, the portfolio manager, and so forth.
Mm-hmm. What would be the goal amount of time to get that down to, from months to weeks, days, hours? Because I'm honestly a bit surprised. I thought it would be faster than that, but I guess there's a lot of like due diligence on the background and curation of it.
Well, we're very particular. So, we'll often make recommendations. It often takes some time, because we'll often ask for something from the issuer. We'll say, this particular way of configuring it doesn't quite work the way we want it to, or you need to make this change. And so that's what actually builds in the time. It would be much simpler if instead everybody kind of hewed to, a template.
This is the template, and here it is.
This is the template. Just go in this box and then fit,
Yeah.
And then you can
like tailored.
Yes, exactly.
Mm-hmm.
Yeah, so that's the only reason. Yeah, it would be easy to just like wave through stuff, but this is just not how we function.
Right. Do you see vaults remaining primarily a crypto native kind of primitive in product, or will it replace a similar structure that we see inside of traditional finance?
We see this as a complete replacement for credit, for like borrow lend activity that would happen in traditional finance. The Coinbase example is a very good one of a UX experience that abstracts the crypto away completely. And that's kind of the role that we see these products playing. So in the Coinbase app experience, you can borrow. Firstly, you can borrow from on-chain venues, from the vaults. So that's already one example of how, that you can do essentially a margin loan with collateral, but financed on-chain off Coinbase's balance sheet. And similarly, if you have stablecoins, you can lend them. And the advantage is that, it's not Coinbase's balance sheet. So there's no principal exposure from the company in like writing these. And the second is that they're non-custodial. So the user has the option of walking away. They can export their private key and they can just go off somewhere else. So if Coinbase were to go bankrupt, those positions would be separate because they're non-custodial technically. And that's how the average Coinbase user doesn't have to think about morpho vaults, stable coins, what have you. I have $100, I deposit in the vault, I lend it out to somebody, and that's it.
How do you think about the different audiences for like institutional product development versus like retail users interacting with products powered by Steakhouse? I would imagine you design them differently for the audiences, but there's probably some similarity of like hoping that there's ease of use there too, right? Or is it more similar than we think?
I think one of the reasons we found that we had a very good product for the institutional channel was because of the way that we had done it for retail. So when we launched the Morpho vaults, it was purely a retail experience, but we tried to be thoughtful from sort of first principles of like, if we were users, what are the sort of guarantees that we would want in these vaults? We would want the curator to be very constrained. We would want the time locks to be extremely long. We would want to give the user a sort of dual governance veto over our decisions so that we disempower ourselves and we mitigate the counterparty completely. And these things I think resonated because they speak to, like coming back to my earlier point, they speak to the reason why you would use these products at all in the first place. If you're using DeFi to interact with a counterparty concentration, full discretion, black box, etc., it's like you may as well just use an ETF or a savings account or what have you. Like there's no differential value proposition there for the user. There's a negative one, if anything. So I think, I don't think I don't think there's actually a meaningful difference. It's more about thinking about the governance rights, constraining them, and the roles of the different users. In the retail environment, it's more about like the individual DeFi user. In the B2B2C channel, it's about how you make that product, how you surface those functionalities for the user or enable them for the distributor so that they can use them on behalf of the user.
Before we wrap things up, I want to talk to you a little bit more about Grove. I know we talked about it at the beginning of the episode, but essentially, as a refresher now, Grove allocates roughly about $2 billion into real world assets. And we talked a bit about real world assets throughout this episode too, but like, where do you expect that growth to go in the near and long term? And then is that growth close to maxing out? Like, is there a limit to this? Is kind of the question.
Yes. So this changes frequently. It's $2.8 billion today. Grove you can think of Grove as a subset of the Sky balance sheet. So Sky, this, excess of $10 billion stablecoin, has a balance sheet that it's divided into stars, and the stars have the responsibility of generating a spread. And they do that by borrowing from Sky. Sorry. So ultimately, the ability for any of these stars to allocate is constrained by the total supply of Sky. Now, the theory is that these stars can build products that are accretive to the demand for the stablecoin USDS. The more USDS there is, the more allocation capacity these stars have. One example of that kind of product is this Grove Basin that I was mentioning earlier, this settlement financing facility for tokenized asset issuers that would allow tokenized money market funds to subscribe and redeem atomically up to like billions of dollars in scale. Like these are the sorts of things because you can redeem to USDS, for example, or you create like pools of new demand for USDS. Like this is the rationale that you would make a product like this. Plus it happens to make DeFi work much more efficiently, which is really cool for everyone. And it's a lot of very reasons, attractive it's good for a lot of reasons. And it's also very good for Grove because it generates economics on the basis of that financing facility. So that's the answer. It's like the maximum cap is the amount of USDS, if you want, divided by the number of stars, more or less, something like this. And so the stars have the mission of allocating, but they also have the mission of growing the supply of the stablecoin in a self-interested cycle. Speaking to the reason one of the reasons Rune designed it this way is because it's incentive compatible, because you create an allocator that has the incentive to grow the liability side as much as the allocator has the incentive to generate the maximum possible spread. And then you constrain them within these asset liability management rules to prevent them from taking excess risk. So that's in the near future, the better Grove and the other stars do, the more USDS there will be. So the higher the limit for allocation that Grove will have, and the more products that Grove can build.
Can you explain what stars are real quick? Some
people
might not know what that is. Yes, I know it's a term from Sky, but yes.
Yes, it's the Sky jargon for Sky is the issuer of USDS, the stablecoin, and star is the name for a mini balance sheet that allocates the assets. It's called star. Right. Yeah.
Got it.
And
good. Do you ultimately think we need RWAs then for crypto and maybe more specifically stablecoins to grow?
Yeah, for sure. But we view it very much as what we need more of is more fudging the lines. So one thing that we're very passionate about is like Grove Basin is a perfect example of a product that does like the fudging of the line. It blurs it blurs the difference between real world asset and crypto because it makes tokenized money market funds that's kind of a hybrid animal, like a token wrapper around fund, what have you. But Grove Basin is a technology that blurs that distinction and just makes it fully fungible with the rest of DeFi. I think this is the sort of thing that we need to make stablecoins work. And also because like Ethereum or Solana or crypto in general, these are general purpose ledgers. So you can do art, you can put NFTs, you can do whatever, you can build anything. Finance just happens to be one of the bigger applications that you can build on it. And in the stablecoin world, you were operating firmly inside the remit of a central bank that issues a currency. So like, the dollar stablecoins are in the silo of the Federal Reserve. The euro stablecoins are in the silo of the ECB. Like you can't evade it. This is the Faustian bargain. Like you play by their rules, right? So it doesn't make sense to think of crypto versus RWA. If you want to have an ecosystem that's successful and thriving, you have to have something that's transferable between the two worlds.
So what would you say is like the next evolution then for RWAs and stablecoins?
Not to harp on Grove Basin over and over again, but I think it coming back to solving a big problem. This big problem that we're referring to is that one of the weird things of DeFi for years has been there's actually no risk-free rate on chain. Like if you wanted to get the federal funds rate in a brokerage or in a bank or whatever, this is very simple. It's actually risk-free, etc. On DeFi, there's always been this friction. It has had the effect of making tokenized money market funds less liquid than other instruments, which is very weird. It creates very strange distortions in how these repo markets work, for example. And it creates a lot of noise around the risk-free rate. It makes it very volatile and essentially very difficult to use. But the moment that you bring in this arbitrage loop that makes it immediate to like close any arbitrage gaps, our hope is eventually we will see SOFR on chain, just like flat, and make like a foundation, like a cement, granite, rock solid foundation on which you can build like repo markets properly. And I think this is like the nerdy market plumbing perspective on why I think after Grove Basin, it will significantly improve.
Yeah. All right, Adrian, aside from everything that we talked about, what is something that you think listeners should pay attention to?
I think they should pay attention to I talk about this a lot. I think they should pay attention to their children. It's something that I think about very often when it comes to thinking about how we build, what we build, the environment that they're growing up in, and what their expectations are going to be. And the analogy that I bring here is something like, I'm based in Switzerland, like there's lots of Swiss banks, and often like the saying or like the chatter is something like the best Swiss bankers are the ones that spend more time with the children of their clients than with their clients themselves, because they're the ones that are thinking, 2 steps ahead. The client will eventually retire or die, and eventually it'll be the turn of the new generation. And so what will that new generation expect? How will they behave? What are the sort of things that what are the sort of things that they will do? What are the sort of things that will interest them? I think thinking well ahead of time is a very useful exercise to think about how to build like stablecoin products and how to do things in a digitally native way.
Do you have children? Can I ask that?
Yes. Yeah, of course. Yeah, I have one. Yes.
Are you testing things with them and seeing what they're interested in?
Constantly. Yeah. I love, stretching her little brain and seeing how she thinks. But it's more like if you think like
of like what the future generation wants and like what that looks like. Yes, of course.
Yeah, exactly. It's like you try and put yourself in their shoes, sort of thing. It's like this is a future consumer. This is like her experience of Apple is the first ever experience of an Apple that she will ever have, and one day she will have that experience with like money. Like what is her reaction going to be to that, and how is that expectation going to change over time as she grows up? I think these are useful exercises to keep in mind, and I think that stablecoins are in that direction, right?
Very interesting. I think this kind of goes into the last question we always ask to wrap things up, but can you leave us with a piece of advice, something that you've carried with you throughout your time in this space or just in general?
I don't feel qualified or prepared to give advice to anyone, frankly, like humbly. One thing that so we were talking about like Goldman Sachs and my career and all this. Okay, so one realization is nobody actually knows what they're doing, really. This is something that became very apparent. Like I left Goldman in the beginning of 2020 to do entrepreneurial stuff. It coincided with the beginning of the lockdowns for COVID, which was a moment that highlighted the maximum absurdity of like actually nobody knows what they're doing and everybody's just making shit up as they go along. All the way from prime ministers and governments to business leaders, like everybody is just making it up as they go. And I find that quite liberating because you can really just do stuff and, not illegal stuff maybe, but, broadly speaking.
Good caveat, yeah.
Somebody will put you in a box if you do that, but if, you can mostly do stuff. And I think this is quite a liberating framing to look at things because it gives you license to experiment.
I love that. That's what you're doing with Steakhouse?
Exactly. Yeah. We have a license to experiment and it seems to be going well. Yeah, fortunately.
Amazing. Well, Adrian, thank you again for coming on today. It was a pleasure.
Thanks. Yeah. Happy to speak.